Welcome back to Investing Talk podcast.
Great to be here.
Today we're focusing on Cava Group, the fast casual restaurant chain doing Mediterranean food.
That's right. We've got quite a bit of info. You shared earnings, expansion stuff, analyst views.
And even a detailed due diligence report looking at 2025.
So our mission today is to kind of sift through all that and pull out what's really important for understanding CAVA right now.
Let's start with how they've been doing lately, their recent performance.
Okay, so they reported fiscal Q4 and full year 2024 results back on February 25th, 2025.
And the headline number was revenue, right? $954.3 million.
Correct, which is a pretty significant jump, 33.1% up from fiscal 2023.
Wow, 33%. What's driving that mainly?
Well, a big part is new restaurants. They opened 130 net new ones.
Okay.
And also strong performance at existing locations. Same restaurant sales were up 13.4%.
13.4%. That's impressive for established stores.
It is. And just in fiscal 24, they opened 58 net new restaurants.
And they're keeping the pedal down for 2025.
It's like it. Planning for 62 to 66 more openings in fiscal 25.
They also added some new things like grilled steak.
Grilled steak, yes. And they rolled out a new labor model, supposedly to improve the guest experience.
Okay, so that 33% revenue growth, that really stands out. And a lot coming from those new openings.
It does. And it suggests they're, probably gaining ground in their specific market segment.
More than just the overall sector growing, perhaps?
Quite likely. That kind of growth rate often means outpacing the average. And that 13.4% same-store sales figure, that's key.
Why is that one so important?
Because it shows organic growth. It's not just about adding more stores. The stores they already have are bringing in more money. Better loyalty, maybe better efficiency.
So the steak and the new labor model might be helping there too.
Could be contributing, yes. It's a healthy sign when growth comes from both expanding the footprint and improving existing operations. Let's
zoom out a bit to 2025 overall. There was a report mentioning revenue hitting $1.21 billion.
Yes, that's a 25.56% increase from the $963.71 million the year before.
And looking even longer term, say 2021 to 2025.
The growth is quite consistent, from about $500 million in 2021 up to that $1.21 billion in 2025.
Which works out to roughly a 23% compound annual growth rate.
Approximately, yes. About 23% CAGR over those 4 years.
That sustained growth, a 23% CAGR, that really tells a story, doesn't it?
It absolutely does. It points to a strong business model and real traction with customers in that fast casual space. It's not just a one-off spike.
Okay, let's dig into the financials a bit more. Fiscal year 2024, if we adjust for that extra week in 2023.
Right. Excluding the 53rd week, the revenue growth was actually 35.1%.
35%. And still that same 13.4% same-store sales growth.
Correct. And their restaurant-level profit margin was pretty healthy at 25.0%.
25% at the store level. That sounds good.
It is. It means the individual restaurants are operating profitably, generate cash.
What about overall net income and debt?
A recent report showed net income at $78.6 million, EBITDA at $22.7 million.
Okay.
And the debt-to-equity ratio was 0.54. Quite conservative.
Below 1 is usually seen as pretty safe, right?
Generally, yes. It suggests they aren't over-leveraged, less financial risk.
And free cash flow, was that positive?
Yes. $52.9 million for fiscal 2024, showing a positive trend there, too.
So that 25% margin at the restaurant level is strong. And the low debt. Are there any downsides to low debt for a growth company like this?
Well, the main benefit is flexibility and lower risk, like we said. Less worry about interest payments.
Sure.
The potential drawback, I suppose, is that maybe they could use debt more aggressively to fuel even faster growth if the returns were high enough. But they seem focused on funding growth more organically and with equity.
Right. And that positive free cash flow helps fund those 60-odd new stores they're planning.
Precisely. It can be reinvested directly back into the business.
Okay, let's shift gears to what the market thinks. Stock price.
As of April 11th, 2025, the price was $90.07. It was up about 1.5% that day. Trading volume was decent, around 1.75 million shares.
And analyst sentiment. We don't have a super recent snapshot, but the earnings seem good.
Generally pointing positive, yes. We do know back on March 24th, 2025, the stock jumped quite a bit, 7.48%.
Oh, wow. Why was that?
Seems like positive market feelings tied to that expansion news we talked about.
And didn't JP Morgan upgrade them?
They did. Upgraded to overweight. They cited the strong growth potential and the consistent cash generation.
So an overweight rating from a major bank like JP Morgan, that's a pretty strong signal.
It definitely carries weight. It shows institutional confidence in their trajectory. That nearly 7.5% jump on expansion news also highlights how much investors are focused on that growth story right now.
But it's not all rosy, is it? There were some potential concerns mentioned.
True. We need to look at the other side. Analysts are actually forecasting a pretty steep decline in earnings per share, EPS, for 2025.
The decline, how much?
Around 53%, down to $1.53 per share. This is despite the strong revenue growth we've been discussing.
Revenue up, EPS down. That seems counterintuitive.
It does raise questions. Also, the return on equity, ROE, was noted as relatively low at 8.7%.
8.7% ROE. What does that signify, basically?
Well, ROE measures how effectively a company uses shareholder investments to generate profit. So 8.7% means for every dollar of shareholder equity, they generated 8.7 cents in net income.
Which might be lower than some competitors.
Potentially, yes. It suggests maybe they aren't squeezing as much profit out of their equity base compared to others in the sector. You want to compare it directly.
And stock price volatility was mentioned too.
Yes, the stock price has been sensitive to market sentiment shifts and these analyst forecasts, which isn't uncommon for growth stocks.
So that projected EPS drop, that's puzzling. Could it be related to the costs of expansion?
That's a very likely explanation. Ramping up openings, entering new markets, maybe investing heavily in marketing or infrastructure, that all costs money up front and can pressure near-term profitability, even if revenue is climbing.
So higher costs eating into the bottom line for now?
It's a strong possibility. The key question is whether those investments will pay off in future earnings growth. Investors will be watching that closely.
And the lower ROE, that ties in too, perhaps. Investing heavily might depress ROE temporarily.
It could. If the equity base grows faster than net income due to investments, ROE can dip. Again, the focus will be on whether that ROE improves as these investments mature.
Let's talk about the bigger picture. Where does CAVA fit in the restaurant world?
They're right in the heart of the fast casual dining sector, which itself is growing.
Driven by demand for what? Healthier options? Convenience?
Both. People want food that's quick, but also perceived as healthier or fresher than traditional fast food. CAVA taps right into that.
And their specific angle is Mediterranean. How does that help them stand out?
It gives them a distinct identity. They're not just another burger joint or Mexican place. Competitors would be like Chipotle, maybe Sweetgreen, even Shake Shack in the broader fast casual space.
But CBE's got that specific Mediterranean flavor profile and the customizable bowls and pitas.
Exactly. That differentiation is key. The health perception of Mediterranean food and the customization are strong selling points. They seem to have carved out a nice niche.
And they have big plans for the future, right? That 1,000 location goal.
Yes, very ambitious. Aiming for 1,000 locations by 2032.
That's a huge expansion from where they are now.
It really is. And for 2025, the focus includes expanding into new markets, specifically mentioning the Midwest. That's where those 62 to 66 planned openings fit in.
So pushing beyond their established regions, that makes sense for growth.
Absolutely. Entering new territories like the Midwest is crucial if they want to hit that 1,000 store target.
What should people watch for going forward? Earnings reports, obviously.
Definitely earnings reports to track progress on revenue, margins, and that EPS figure. Also, any new product innovations or changes to the menu will be interesting.
But there are risks, too. Competition isn't going away.
No, it's a very competitive space.
Yeah.
And broader economic factors are always a risk. If there's a downturn, people might cut back on eating out, even fast casual.
That due diligence report we mentioned earlier, did it add anything specific?
It highlighted their strong brand recognition in that Mediterranean fast casual niche.
So people know the CVA brand.
Apparently so. And it also noted, consistent with what we've seen, that their revenue growth is outpacing the broader industry average.
Which reinforces that idea of them capturing market share.
It does. Strong brand plus faster than average growth is a potent combination. It suggests their strategy is resonating well.
Okay, so let's try to wrap this up for listeners. What are the key takeaways?
Well, CAVA is clearly showing really strong revenue growth, fueled by aggressive expansion and solid same-store sales.
And their financial position seems pretty sound, right? Good margins at the store level, manageable debt, positive cash flow.
Yes, the underlying financials look quite healthy, and the market, particularly analysts like JP Morgan, seem to view the growth story favorably.
But there are things to keep an eye on.
Definitely. That projected EPS decline for 2025 is a big one, Investors need to understand why that's happening, likely investment costs, but need confirmation.
And the return on equity being maybe lower than peers is another point of attention. Efficiency matters.
It does. So strong top-line growth and potential, but questions around near-term profitability and efficiency relative to shareholder equity.
They have a unique position with the Mediterranean focus in a growing market segment.
A definite plus. But they can't rest easy, competition is fierce, and economic headwinds are always possible.
What's really interesting, maybe the core tension here, is that contrast you mentioned, soaring revenue but falling EPS, at least in the forecast.
It really is. It brings up that crucial question for anyone looking at the company. Is this dip in profitability just growing pains, the cost of scaling up rapidly?
Or could it signal something more fundamental about their cost structure or the long-term profitability of their model as they expand?
Exactly. Figuring out whether this EPS pressure is temporary or a more structural issue is probably key to assessing the long-term investment case here. Digging into their operating expenses and investment returns might shed more light.
We hope this breakdown has helped clarify the picture for Cava Group based on the information provided.
We trust it gives you a good starting point for your own thinking.
And if you found this analysis useful, please do subscribe, like, and maybe drop a comment if there are other companies or topics you'd like us to look into.